more color on that now. Rohit Seksaria, who's the equity fund manager of Sundaram Mutual, joining us now. Hi, Rohit. Thank you so much for joining us today. Good afternoon to you. Rohit, the big bumper bonanza that we got in the form of a 50 bips rate cut on Friday and a CRR cut of 100 basis points, from that we have seen the markets move up, and we've also seen a lot of buying coming in from the FIIs and the DIIs as well. Thereafter, are the bulls back in the market really? How should one be placing their bets now? How should be one looking at the market, say, for the next 6 months to 1 year? We also have the inflation that has been cooling off. The food inflation has come off considerably. How should one look at the markets now?
Absolutely. So we remain very constructive on the markets from medium to long-term perspective. There are multiple levers which are driving the market or which are providing a better growth impetus on medium to long term. So one, as you rightly pointed out, is the significant rate cuts which RBI provided, and not only rate cuts. RBI has been injecting liquidity. Liquidity has moved to surplus, and the CRR cut will further aid the liquidity in the system. So that will be one big driver in moving up the trade growth rate. The other big driver will be the crude price correction, the benefits of which will flow through the economy, either in the form of, let's say, if government increases excise duties, then government will get more money, which government will spend, or if they cut the fuel prices, then consumers will benefit, and that will lead to higher consumption. And lastly, the income tax cuts, which we got in the last budget, the benefits have just started flowing in. Come festive, we believe that should lead to uptick in consumption. And all this combined, we believe that we have a good positive growth momentum going into the year, especially in the second half. And that's why we remain constructive on the market from medium to long term.
Okay. Hi, Rohit. This is Kanishka also joining in. Before we discuss the consumption sector in detail further, I want to ask you first, within your portfolio, are you looking to, make any rotations there, especially with respect to the rate sensitive sectors, since the RBI announcement has come, financial services, real estate, gold financing companies, any changes that you're looking to make to your portfolio?
Actually, we have been quite constructive on the entire BFSI segment for more than 6 months now. And when I say BFSI, we have been more constructive on the lending financials. The changes or some marginal changes, what I would like to make now is we are getting more constructive on the smaller banks and smaller NBFCs now. We believe that the amount of liquidity which RBI is injecting in the system, the smaller banks and smaller NBFCs who are finding it difficult to raise deposits or raise borrowings, for them life will be much easier going forward. They will be able to show much better growth, and they are available at much cheaper valuations. So that's one segment where I would like to go get more in.
So banks is, of course, as I can see, also your biggest allocation is into banks, but you're also bullish on the auto components. Speak to us about the auto pack also. What is making you bullish on the auto pack, especially the auto anchs, as I can see?
Yeah, auto anchs, we have been bullish because they have been gaining market share, especially both in India and outside India. And what is happening is the newer components, the proportion of newer components in the automobile is increasing. And together with that, because they are getting market share, the overall growth rate is quite impressive. But this here, it becomes much more stock specific rather than, I would say, for the entire sector.
Okay. Now, coming to that consumption discussion again, Rohit, now you did mention that, the rate cuts and crude prices, income tax, the changes in the income tax return, those are the things that are expected to drive the further leg of growth. But, consumer durables are a very significant part of your portfolio. So how do you see the demand trends shaping forward, given that rural recovery has sort of started to begin, but urban demand continues to remain sort of sluggish? What's the outlook there?
See, that's why I said I believe somewhere towards the festive, we believe that even the urban demand should pick up. What happens is in most of the consumption demand, you need some trigger. Festive has always been a good trigger for consumption, and that's why we believe somewhere towards the festive, both urban and rural should start driving the demand. So as you mentioned, durables. So within durables, we remain positive, though the seasonal categories like AC this season has been washed out. But from the longer term perspective, we remain positive on the entire segment, whether it's durables, whether it's luggage, whether it's restaurant, hotels, hospitals. We remain positive across the entire consumer discretionary basket.
Right. So Rohit, you said you mentioned the consumer discretionary basket also, but within the discretionary basket, there, it's a big basket. Where do you see value? Because if you look at the aviation sector or the hospitality sector, that's already run up quite a bit. So within the discretionary basket, what are the pockets of value?
Actually, within the consumption basket, it's very difficult to find pockets of value. Consumption basket, what we are playing for is a higher growth rate and higher long-term growth rate. And that's why I agree with you. Valuations are rich. Some of these stocks have moved up, but we believe they will continue to remain rich as long as the growth sustains. And we believe this growth will pick up from here and can sustain for longer.
Right. Rohit, okay, talk to us about the IT pack. What's your view on IT? Because, a lot of analysts are finding a lot of valuation comfort in IT, even though the macro headwinds persist, just primarily on the back of valuations. IT looks like a good bet, but how about that in the long run? Because the macro headwinds still persist, right?
Yes, IT has macro headwinds from two sides. One is the slowdown in US, which everyone is expecting. And secondly, how does the AI and Gen AI impact the IT services? That said, much of that is priced in and valuations have corrected. I was actually just last week speaking to a friend, and what he was telling me, this Gen AI is blown out of proportion. Some part of services may get impacted, but that may be just 10 to 15% of their services. Most of the services remain unaffected right now by Gen AI. So to that extent, as and when the market demand pick up, you will see the growth bouncing back in IT. And that's why we have a neutral call on IT. And right now, we'll wait for signs for demand revival. And that's where we'll turn more bullish.
Point taken. Now, Rohit, I also want to take your view on the defense pack. Now, with respect to both momentum and valuations, a significant rally has already come in these names, especially in the past months since, against the backdrop of border tensions. Now, do you expect this trend to continue? Order books have been robust, as we saw in the Q4 results, but execution has remained a concern for some of them. So what's your outlook for this particular sector?
Defense, I have generally avoided, mainly because of what you pointed out, execution is weak. There are orders out there for taking for someone who can execute it well. But what we have figured out is execution can be weak not only because of us, execution may be weak because of our dependence on imports for some components or for some other reasons. So right now, market is pricing in far too much optimism in defense. When the time of execution comes, what we have seen in the past is generally we have been found lacking to the extent market expected. And the way the valuations are right now, that doesn't provide me comfort. So that's why I'm staying away from defense right now. But if I talk of slightly longer term, that's a good theme to track. And at right valuations, that may be a good theme to get in.
Thank you so much for joining us and weighing in on the markets. Pleasure to have you on the show. With that, it's time for a quick breather. Don't go anywhere after the break. We're getting you more updates on the market. Stay tuned.